Hey, this is Bubble Analytics, and this week we're going to create a strategy around the Vortex Indicator. So the Vortex itself is a two-line indicator. It's made up of what they call positive and negative vortex movement. So for positive, that would be today's high minus yesterday's low. We take the last 14 values, add them together, and then divide that by the 14-period sum of true range. And for negative vortex movement, that would be today's low minus yesterday's high, add the last 14 values together and then divide that by the 14-period sum of true range. And true range itself would be the maximum value of today's high minus today's low, or today's high minus yesterday's close, or today's low minus yesterday's close. So typical strategy implementation is going to tell you to buy when the green line, the vortex bull, rises above the red line, the vortex bear, and sell when you get the reverse. And what it's telling you is when the lines start to diverge and move far apart, that suggests strong trend strength in either direction, and frequent crosses of the two lines suggest a sideways to down market. We're going to look at three different ways of using the Vortex Indicator to create strategies, and we're going to beat the market. So if you're ready to code it up, please read the disclaimer. Okay, let's get into it then. So I've opened up a fresh Jupyter notebook, renamed it Vortex, and I'm just going to click in the first cell, hit shift return a few times to create some empty cells. We'll be saving time today by copying and pasting from our template. This just contains repeatable code snippets that we use each time to create a strategy and then backtest it. Both the completed notebook and the template are available to download for free. You can get that via our website. The link is in the footer here. It's in our GitHub account. So get that for free. So let's make a start then. So first thing, as always, would be to import our libraries. These contain pre-built functionality we're going to make use of to run our strategy. So I'm going to paste that in there, hit shift return to run it. And then the next code block here is going to download some historical market data from Yahoo Finance. We're going to use the Y Finance library, which we imported here as YF. Keyline is the one at the top here. So we're going to use the Y Finance library using its download method to take 10 years worth of daily time frame data for QQQ and then store it in a variable called DF. So if I paste that in and hit shift return, this is the output you should expect to see. So what we're going to be recreating today is the Vortex Indicator. So I'm in stock charts here. If you want to read about the indicator and how to use it, you can go and read this article here. It's very good. But this is the indicator we're going to create today. So it's basically made up of these two lines, one in green, one in red. And one of them is the VI bull, or the Vortex bull, and one's the Vortex bear. And to recreate it, it is this. So effectively it's comparing the current high minus the prior low for positive vortex movement, and the current low minus yesterday's high for the negative vortex movement. And it takes the absolute values because we don't want negative values in our data set. Then we create a 14-period sum of these movements, and then we divide that by the true range, 14-period true range. And the true range itself compares three different metrics. So the high minus the low, and then the current high minus yesterday's close, and the current low minus yesterday's close. And again, we take the absolute values to get rid of the minus signs for those values. And then what the true range does is compare them and return the highest. So what we'll do is copy this across, and we'll just start putting that together now. So if I paste that in there, just so that we know what we're looking for. So I'm going to define a function called Vortex, and that is going to take some data. So we need to tell it where to find these high, low, and close values. So that's going to take some data, and also needs to take a look back period. So we're going to use the 14 period today, but we use n because n can be representative of any look back period. And when we call our function, we can tell it to do the vortex based on the 10 period look back, or 15 or whatever. So first thing to create then is the positive vortex movement and the negative vortex movement. So I'm just going to call them pos VM and neg VM, and then all these are then is the absolute value of the current high. So that would be data high minus yesterday's low. So that will be data low, and then we're going to use the shift method to return the row before. So one row before, so basically yesterday's low. So if I use the shift method and we're on this row here, it will return this value here. So that is the positive movement, and we're just going to copy this across and create the negative movement, which is the current low minus yesterday's high. So we're just going to flip these around. So that is the low minus the high. And then what we're going to create now is a 14 periods or an n period sum of these values here. So I'm going to call that pos VM sum and neg VM sum. And then all these are 14 period rolling windows added together. So effectively we take the pos VM value that we created above and then use the rolling method, give it n periods, and then from that we calculate the sum. And then same thing for the negative value. So we're just going to change that to neg. So that's that part done. And now we're going to calculate the true range. So there's nicer ways to do this. I'm going to do this in the most obvious way, the least Pythonic way. So we can get away with creating this function with a lot less lines, but I think it's just easier to read. And if you're new to coding, it's probably going to be easier for you. So what we're going to do is create 3 different methods. So call that meth1, meth2, and meth3. I don't know whether we looked at this already, but if we come and have a quick look at the average true range here in stock charts, this is what they call them: method 1, method 2, method 3. So method 1 is the current high minus yesterday's low, the current low, and then the method 2, current high minus yesterday's close, and current low minus yesterday's close. And again, we take the absolute values and then return the highest one. So that's method 1, method 2, method 3. So method 1 then would be so we'll put it in brackets anyway. So that would be our current high minus our current low. So that's our first method. Method 2 then would be equal to the absolute value of our current high minus yesterday's close. So that would be our close. And again, we'll use the shift method to take the row before. And then method 3 then would be, in fact, we can just copy that, can't we? So, okay, and that would be the current low minus yesterday's close. So, and then what we're looking to do is take only the highest value. So we're going to compare these 3 values and then take the highest only. To do that, we're going to use NumPy, the NumPy library. So where you see NP, that's us declaring we're going to use NumPy. And what we are going to do is create our true range then, which would be equal to NumPy.maximum. So we're going to use the maximum method. What that does is return the maximum value. It compares values and returns the maximum. But because our maximum, in fact, I'll just show you. So the maximum method can only compare 2 values. So the first thing we're going to do is compare method 1 and method 2 and return the highest value from that. But that's not enough. We've got 3 values. So what we're going to do is create another mp.maximum. And what we're going to do is nest these. So effectively we're doing it twice. So we're going to return the highest value of meth1, meth2, and then compare that highest value to meth3. So which is just like that. So, and then we want to return an absolute value. So we're going to need that. And then I'm just going to make sure I've got enough brackets. So we got 1, 2, 3, 1, 2, 3. There we go. So there you go. So we're nesting the maximum method here, NumPy's maximum method, because it only takes in two values and only compares two values. So we'll first of all take this one here, which compares method 1 and method 2 and returns the highest value, and then take that value and compare it, use again another np.maximum to compare that with method 3, and then return that highest value. And then the true range sum then is equal to the 14 period sum of that true range. So again, we'll take the true range that we calculated above here, use the rolling method, and then it's going to be n periods, and then but we'll take the sum from that. So so our vortex indicator bool then, which I'm just going to call vi bool and vi bear, all that is the positive VM sum that we calculated above here divided by the TR sum. So, and then, and I'll just copy that. And then for the bearish is the negative vortex movement sum that we calculated above divided by the sum of the true range here. So, and then all we want to return from our function is vi bool and vi bear. So those are our two lines that we want to return from it. So I can get rid of this now, and then what I'm going to do is create a new column within our existing data frame. I'm going to call that, well, two new columns, sorry, vi bool, and that should be, when you name it, you need to put it in little speech marks. So vi bool and vi bear. And then that is going to be equal to us calling our new function vortex, and then tell it where to find our data, which is in df, and then what our look back period is going to be. So if you wanted a 10 period look back period, you just specify that there. And if I hit shift return here, check these values out now. So if I wanted to change that to our 14 period, which is what we're going to use today, I'll do that. But you see that I haven't had to change anything in my function here to do that. I've just changed it by calling the function and telling it what look back period I'm looking for. So that's our vortex indicator created. Bit of a long one, but we are there. Only have to do this once in the code book. And then now we're going to create a chart from it. So what we're going to do is recreate this chart here. So this is all one big column, one column with two rows of data. In row 1, we've got our price data. In row 2, we've got our indicator. So I'm going to come back up into our template, and I'm going to grab all of this bit here. And I'll leave a little bit of a gap. So all this does is tells Plotly to create, well, we create a variable called fig, and then inside fig we're going to store all our chart settings. So we're telling Plotly that we want to make a subplot with one column and two rows. And for our row heights, our first row is going to get 68% of the screen real estate. Our indicator is going to get 32%, so our row 2. Then for row 1, which is here, we're pulling in our OHLC data, so our open, high, low, close data, dictating what color up bars and down bars will be, so green and red, and then telling it which row we want to put the data in, which is row 1 here. So that's that bit done. And let's come back and do the chart styling section. So I'm going to take all of this and then pop that in there. And if you notice on our vortex chart here, there's a line at 1. So I'm going to recreate that today. So, and that is this line here. So we are adding a H line, a horizontal line to our indicator data. So that's going to be in row 2, and a line width of 0.5 in a grey colour. And we're going to want to put that at 1. And then this part here just governs the theme. So we're going to use a dark theme for our chart. Make it 1100 across and 700 up, and this one just updates our grid color. And then probably the only hard bit here is we want to show the month and date on our x-axis, and to do that, when Plotly renders price data, it doesn't understand that there's no data on a Saturday and Sunday, so it just renders a blank. So what we're going to do is create a range break within the x-axis. So we're going to update our x-axis, creating a range break that starts on Saturday and ends by Monday, so effectively excluding Saturday and Sunday data. So that is that part, and I think we've got a histogram in there that we didn't need, so I'm going to get rid of that. And then the last bit that we want to do is render our two indicator lines. So we're going to add some indicator data to our indicator subplot. That's that bit there. So let me just grab that. And then we're going to need this twice for each of our different lines. And with these ones, all you need to do is tell it which column to go and look in for the data. So if you see here, we named ours VI bull and VI bear. So we just need to tell it that is the name of the column that we want to render on the chart. So VI bull, VI bear. And then to sort of mimic this then, it looks to me, doesn't actually dictate, does it? But I think the negative one is it. So the bear is in red and the bull is in green, I'm assuming there. So our bear is in red and our bull I'm going to keep light sea green, and then I'm just going to make the line width a bit bigger. And we should really give the labels. So our vortex bull and our vortex bear. Okay, so, and then the final thing that, because we want to render the month and year on our x-axis, we need to set the index, or set the date column as the index. So just grab that last little line there, pop that above, and if I now run everything here, we should theoretically, there we go. So now we've got our vortex indicator. We can go back in and check to see, does it look the same? And it looks pretty good. So that is the vortex indicator. You can see we're rendering data from the start of our data set here. If you remember, we need 14 periods before we can actually render any sort of data for these two lines. And that gap there is evidence of that basically. So, but if we go in and change the slice of data that we want to render on our chart, you can see here that we've got 2,514 rows. And typically I will go in and render the last sort of 300-ish. So 350. And then if we start the bars at 2200, so we're going to start at bar 2200, rendering the next 350. If it's there, it's going to be 314. So run all that again, and we should have more up-to-date data. So this is the most recent price action in QQQ rendered. So in terms of how we use the indicator, it's kind of choppy. You can see, you could probably use it for movements up and down, up above 1 and below 1 maybe. Or you could do what stock chart sort of advises you to do here, which is to use it just for simple crossovers basically. So when our VI bull crosses above our VI bear, that's a buy signal, and vice versa. So you can see they've given you some ideas for that there. Not always the most effective, but we'll pop it on anyway, just so we can see what it is. So let me set that up then. So I'm going to come in here and take my signal function and paste that in here. And then I'm going to take this section here, which is how we create entries for our chart. And then finally take this section here, which is how we actually put the entries on the chart. So let me go and add that in there, and then I'll kind of explain what's going on. So what we're going to do is create a signal function. So we're going to create a new column within our data frame called signal. And in it, we're going to tell, this is what the backtesting library uses to know when to buy and when to sell. So what we're going to do is run a loop over our data. So that's this line here for I in range. So we're going to run a loop over the length of our data, going row by row, looking for our buy and sell parameters to be hit. And where our buy parameters are hit, we're going to put a 1 in our signal column. And where we get a sell signal, we're going to put a 2 in our signal column. And if there's no signal, just be 0. Okay. So, and then once we've got our signal column populated, these functions here, what they do is look for a long entry. It looks for a 1 in the signal column, and where it finds it, it returns the low price for that row. And then where we get a sell signal, which is a short entry, it returns the high price, plus a little offset, minus an offset here. And then it creates 2 new columns within our data frame for long entries and short entries, with those prices at the times where we had a 1 or a 2 in our signal column. And then what this little code snippet does is it looks in that newly created long entries and short entries columns, and where it sees a price, it creates a marker. So for a long position, it's going to create a marker, which is going to be a white arrow up, size 7, and for a short, a sell signal, it's going to create a gold cross. All right, so now all we need to do with that all in place, all we need to do really is tell it what our strategy logic is. So all we're going to be doing for the first one then is doing bullish and bearish crosses. So when our green line here, in fact, let's go and move in a bit. So how we're going to do that is say, well, if yesterday's Vortex bull, which I've spelt a little bit wrong there, see, but if yesterday's Vortex bull was below the Vortex bear, so if green was below red yesterday, and today's green is above today's red, then that would be a bullish cross, and that would be a signal to get long, and then it'll be vice versa for our sell signal. So there we go, we can't have that, can we? So to do that, we're going to use the .ilock method. So when we create our signal function here, we specify for I in range. So I is effectively the current row, and then I minus 1 would be yesterday's row, I minus 2 the row before that, so on and so forth. So what we're going to say is if our VI bull yesterday, so that would be .ilock I minus 1, was less than our VI bear yesterday, so .ilock I minus 1, and I'm just going to copy that to save a little bit of time, to save on spelling mistakes. So, and today's value of VI bull, which is now no longer I minus 1, that would be I, and is greater than our VI bear today. So then put a 1 in my signal column. So if yesterday's VI bull was below the VI bear and today's VI bull is above VI bear, then that is a buy signal. And then what we're going to do is just copy that across and reverse it for a sell signal. So if I come in here, pop all that in there and then just reverse it. So for a sell signal, if the bull is above the bear yesterday and below it today, that would be our sell signal. So if I now run all this, we should theoretically, so this, by the way, gives you your value counts for in your signal column. So it tells you how many times each one, a buy signal for a 1, a sell signal for 2. So for example, we got 102 sell signals, 101 buy signals, and the rest were zeros, right? So that tells you that there, but also it now plots it on the chart. And you can see that, how, what it's trying for, this indicator, is to hold for long periods. So what you're hoping for is that we get a bullish cross like we did here. And then the VI bull line here in blue stays above the bear line in red. And that way we get a lot of, a decent bit of price movement before we get a corresponding sell signal. So, but what we also know, and this is the same for most indicators, without any kind of customization anyway, but what we also know is that flat periods, where price goes flat and becomes range bound, is going to lead to a lot of oscillation within these two signal lines, so these two indicator lines here, and that leads to a lot of whipsawing type signals, and you're probably going to lose a lot of money in these periods. So what you're hoping for is good price movement. So like for example here, so we buy here and we don't sell until there, or we buy here and we don't sell until here. But this kind of action where it's flat or sideways to down is going to absolutely murder your return. So let's just test that out anyway. So I'm going to come in and pull our backtesting script, and we're going to take all of that and paste that in here. And then we're not going to sell after a certain amount of time, so I'm going to get rid of that. And we're not going to trade on the close, and we're not going to hedge. So effectively, we're only ever going to have one open position at any one time. So that's this line here, exclusive orders equals true. And we will be trading, or we'll be buying our position on the open following a buy or sell signal. And then for each side of each position, so when we go long and then when we close that long position, we're going to pay a 0.05% of trade value fee, so 0.1% of the amount invested in the trade for a round trip. So a get long and then sell long, and then no leverage. So margin equals 1. I'm going to start with a cash balance of 100 grand, and yeah, and that's it. So if I now run this, this is what we get in raw format, and you can see it doesn't do very well at all. So you're in the market all the time, and it made a whole 47%. And the drawdown's probably better than what the market actually gave you if you were a buy and hold investor, but still not very good. 202 trades, very low win rate, not very good at all. So what we're going to do is try and improve that a little bit, and playing around with it. Before I started recording this, there is no real way of taking the sell signals and making any money on the short side. So we're going to make this a long only strategy. And then because what we want here, we don't want to hold positions too long if they're going against. So what we're going to do is set a fairly tight stop. So stop loss would be equal to 2%. So what I'm comparing that to 0.98 of this price. So this price is the price as at the close of a bar with a buy or sell signal at. And then for a stop loss on a long position, the stop loss obviously would be below the price. So it's 98% of that price. And then for our take profit, what we want is to take big swings with this. So we don't ever want to sell positions like this early. So you don't want to be taking a 3% or a 4% profit when you could be holding it all the way up here and taking a monster. So we're going to give it a long leash and good R2R. So I'm going to make that 12%. So that is going to be 1.12 times price. So again, 12% above whatever that price is at the close there. So, and if we run that again, what that turns into is 280%. You're in the market just over half the time. You make less than half the return, so not brilliant. The drawdown is quite low, however, and even though your win rate's poor, you've got just enough trades really to be sort of semi-happy with it. Your best trade made you just over 12%, and your worst trade lost you just over 4%. There must have been a gap down for that. And the average trade makes you 1.3%. So not bad, not brilliant, just not bad. And given that you have a stop loss in place for this one, and fairly low drawdown, you probably could get away with using a bit of leverage. So if I make that 2-to-1 leverage, you can see you would juice your return quite favorably, making, over 1,000%, 1,100% there. And the only effect really, it wouldn't affect any of your all stats. The only effect is going to be on your drawdown. So your max drawdown would effectively double. So, not that we would advocate the use of leverage. We don't use it. So, okay, so that's our first strategy. Now what we're going to do is play with the data. So, that's our first strategy done. We are going to, let's create some more cells because we're going to need them. We're going to use this data and then sort of make a custom indicator for it, or two different types. So the first thing that we're going to do is, rather than having two lines for this indicator, we're going to calculate the spread. So that basically would just be the VI bull minus the VI bear. So we're going to calculate a spread. So I'm going to create some more columns within our data frame. So this one is our spread, and that would be equal to, there we go. So our VI bull minus, oh my dear, there we go. Our VI bear, there we go. I forgot, I'm not putting this in a function, so I'm just going to take the DF version. All right, so it basically, the spread, so the spread between them is going to be our new line, or our new column in our data frame called spread. So, and in fact, while we go along here, I will recreate it here. So I'm just going to grab the chart section and pop that in here. And then what I will do is comment out the bits that we don't need for the time being. So that would be the entries in this part here. And then you can have a look at what the line is going to look at. So if I run this now, I will have created a new column, there we go, called spread within our data frame. So, and what we're going to do is, instead of displaying the VI bull, we're going to display that instead. So if we make that, and then we just run the chart, this is what it looks like. So now we've got the spread between the two lines. In fact, we don't need that anymore either. Let's run that again. So this is the spread between the two lines now. So rising from negative to positive, broadly between sort of minus 0.5 and plus 0.5. So, and you could probably create a strategy around just that line, but it's you know, you'd maybe, if you were going to go line moves above 0, then chances are it's going to be exactly the same as in fact, it probably will be exactly the same as the strategy above. So we're not going to do that. Instead, you'd be looking for turns in this line, but it's a bit too jagged, and you're going to get a lot of false signals if you do that. So what we're going to do is customize it a little bit more. So we are going to calculate the momentum. So the momentum for this spread line here, we're going to create a spread momentum. So let's create another column in our indicator. I'm going to call it spread mom, no jokes. And that would be equal to our spread today minus the spread 9 days ago. So I'm going to calculate the 9-day momentum. So that would be shift and then 9 in there. And in fact, let me just run that and make sure I haven't made a mistake. Okay, yeah, so we got some nice values in here. And then if we now, so actually, I'll show you what it looks like. So if we now go and have a look at spread momentum, you can see it's changed the indicator a little bit. So the indicator isn't getting above 0 and then holding above 0 until we get a cross of the VI bull and VI bear, which is what that was showing you before. It's giving you more of an oscillator type movement, which is more useful. So, you know, lows, highs, or temporary highs, temporary low, etc., etc. But again, with this line, if we were to sort of look for places where it turns up, for example, this is how we're going to use it in a minute. We're getting so many false signals because the line is so jagged. So, for example, this section here, if we were saying, well, we're going to go long every time this turns up while below 0, so we would get a buy signal here, 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 so on and so forth. So that's no good to us. So what we're going to do is, take a rolling period of that. So I'm going to create a third value in here, which is going to be our, I can't remember what we called it, but I think we call it just smooth. So smoothed spread momentum, basically. So our smooth mom, and that would be equal to our spread momentum dot rolling. And for this, I'm going to use an 8 period rolling window, and from that I'm going to take the mean, so calculate the average, if I could spell. So if I now go into change this to our smooth momentum, okay, and then run that again, so this is much easier to use. So now we sort of format our data a little bit, making it much easier to use, and the strategy is going to be then buying when this line is below 0 and we get a turn up. So, and yeah, you're going to get multiple signals in places, but a lot of the time this is going to be nice. So, and what we're going to use .ilock again. If I sort of zoom in a little bit to here, probably hard to see actually, but you can see that on September the 8th, this value is higher than September the 5th, and September the 5th is probably lower than September the 4th, and so that would count as a turn. Well, that's how we're going to do it. And again, we're going to use the .ilock method. So let's go and just copy all of our stuff from here. So I'm going to grab all that to hopefully save a bit of time now, and then we're going to recreate our signals and then recreate our prices, and then what else do I need? I think that's it. So, and then I will uncomment that because we're going to be adding some of these entries onto the chart. And then what else? I don't need that anymore. And I'm not going to bother with the H line anymore either. So, okay, so all we're going to do now then is amend this function here. So we're no longer looking for crosses of the VI bull and VI bear. What we're looking for is a turn up while below 0 for our smooth momentum, we called it. In fact, I'll change the name here just to be a bit OCD. Smooth momentum, right? So, and run that. So what we're looking for this line here then, we're looking for turn-ups. So we're going to trade those. So if I just delete all that, let's just start again. So we're going to take our smooth momentum .ilock So the first condition then would have to be like today's value of the smooth momentum line would have to be greater than yesterday's value. So data smooth one. So I like yesterday would be represented by I-1. So that would be our first condition. And then for our second condition, in fact, I'll tell you what, let's put this on a different line. For our second condition, I'm just going to copy that. Okay, so for our second condition, the yesterday's line would have had to have been less than the day before it. So I-2. So that's our buy signal. Oh, and sorry, the value of smooth momentum would need to be less than 0. So basically, when that line is below 0 and we get a turn to the upside, we're going to put a buy signal. So that's that. And then for our sell signal for this particular strategy, all I'm going to class that as is when our smooth momentum has been above 0 and then turns back down below 0, and we'll get a sell signal for that. So very basic. So that would be equal to, so our smooth momentum yesterday had to have been greater than 0, and our smooth mom today would need to be less than 0. So, okay, so I think that should work, right? So let's go and pop that in and have a look. What have I done? I need a bit of that, and I've got one there, so that's fine. Okay. Let me run all that again. As it spazzed out a little bit. Sorry, Jupyter can do this. So all you need to do is restart your kernel and run all cells. He says, there we go. It's getting going now. Look. So that was our first one. Look with our first result for our backtest. And then what have I done? What have I done there? Do the smooth one, I like I-1. Okay, that looks fine. Oh. There we go. So you need that. Today's value of smooth mom needs to be underneath there. So let's run all that again. Okay, so and now we can see we have our new, there we go. So we've got 130 buy signals, 86 sell signals, and rendering on our chart here, you can see you get more sell signals for a start, and probably better sell signals, but it looks like the quality of your buy signals also a bit better. So if you remember, if we go up and have a look at this chart, for this buy signal came here April the 9th, whereas this buy signal here is coming April the 1st, more, a week before. The old one gave you that, the cross gave you that signal to buy. So, all right, let's put that one to the test then, this strategy. So to do that, I'm going to grab this whole backtesting function here and pop that in there. And then for this one, we already kind of know that the sell signals are not so good on this one. And just looking at the chart, you can see sell signal here wouldn't have done you any favors, and same here and same here. And all right, that one, you probably would have got away with a quick profit, but these ones probably not going to be that good, that one either. So we're going to use this as a long only strategy, but rather than setting any profit targets or not, I'm just going to let it run. So what I'm looking from this one is to capture, because there's enough sell signals and plenty of buy signals, I'm not I'm less worried about sitting out of the market. So if I get a buy signal here and a sell signal here, so I close my long position here, I'm only waiting a short time before I get another buy signal. And then sell here, buy here, sell here, so on and so forth. So on the old strategy, or the first iteration, I suppose that would have been all right, really. But this one, I'm not going to use any kind of profit target or stop loss. Just going to run that again. And you can see you're in the market a bit less. but you make more money, 410%, and your drawdown's a bit higher. But your win rate increases, and you've got 83 trades, so not a hell of a lot. You could probably play with this, or you probably should play with this. I've not really looked at it in any real depth. So you should probably play with your stops and your losses here just to see if you can improve this a little bit, because that's kind of a meaty, worse trade, isn't it? That one. So, and this is the Qs, don't forget. So it's not like earnings are going to, hurt your strategy. So that's the second way to use the data then. The third way is quite a bit different, really. So I don't need to do any of that again. Let us actually, we'll just get on with it, right? So what we're going to do now is create Bollinger Bands of this smooth MOM data line here. And what we're going to look for, so we're going to create some Bollinger Bands for this data, and then look at long and short positions whenever our smooth MOM line is closing outside or below the lower band, and then back in, so on and so forth. Let me just set it up and you'll see what I mean. So I'm going to create a new function called bands, and Bollinger Bands taking some data. So normally you would tell it where to find the close price or the average of the high-low close price, that kind of thing. But in our case, we're just going to take some the value of the smooth momentum line, and then it always needs 3 numbers, or should have 3 numbers. So that would be the average that you use to calculate the midline, and then the 2 standard deviations. So you want to give yourself, with this one, you want to give yourself a bit of option in terms of you could have Bollinger Bands with 3 standard deviations for the lower band and 2 standard deviations for the upper band, or vice versa, that kind of thing. So all right, let's create a bit of space and we'll get onto it then. So what we're going to take is take our smooth values. So we're going to take the value of this smooth MOM column here. What did I call it? Yeah, it was just smooth MOM, right? So we're going to take that value, so our smooth value. So I'll just call that SV. And that is equal to smooth MOM. And that is it, I think. Yeah, so... And then what we're going to create is we need our mid band and then our standard deviations as well. So standard deviations is simple. So what we're going to do is take in our smooth value here, SV, that we calculated above, and then we're going to create a rolling window, which is going to be equal to whatever lookback period we set for our midline. And then from that, we take our standard deviation, and that is that. So, and then for our midline, which we're actually not going to render on our chart, but we need to calculate it anyway. So our midline, that would be equal to our smooth value above. Same thing, basically. So taking our rolling window for our main lookback period, but from that, we're going to calculate the mean instead of the standard deviation. So that's those calculated. So for our upper line and our lower line, so our upper then, that would be equal, I've got to remember this, that would be equal to our midline plus the standard deviation times N2. And then, that's right, isn't it? We'll find out in a minute. And then for our lower band, again, we're taking the mid, but this time we're taking off our standard deviation times, it should really be like N3 really, but so you can have different sort of standard deviations for each of the different lines. I'll explain that for me. So, and then for our function, I think that's it really. All we need to do, what you would do normally for Bollinger Bands, is return the midline, low, and up. All right. So I should really do it in the other order, shouldn't I? There we go. So if we create 3 new values. Actually, I'll just do 2. So let's create the, I have 2 now. In fact, let me get rid of that. And I'll just get the upper and the lower. I should prepare this better, shouldn't I? So, and that would be equal to bands. And then we're going to tell it where to find smooth MOM, which is in DF. And then we'll just do a standard. So a standard Bollinger Band for now, and we'll see how that works out. And let me just run that and make sure I've got values. Okay, good. All right. So we've got some values in there. So fingers crossed that was the right one to do. And then what we're going to do, let's represent them on a chart first. Let's do our chart, because that way we'll be able to see whether something's going wrong with it. So I'll leave a bit of a gap like we normally do. So we want our smooth momentum indicator, but we also need our upper and lower bands. So when we created this, we created two new columns called upper and one called lower. So we're going to add in some of this indicator data to our subplot. In fact, let me just do that now. So we need that twice, and then one is going to be upper, which I will make red, and we'll make the lines a bit smaller, and then the other one will be lower, and I'm going to make that, I'll keep that, yeah, green, and then what we'll do, I'll tell you what, we'll make this white. Alright, so let me just see whether that's going to work. Right, so if I run everything from there, let's go and have a quick look. There you go. Alright, so our smooth momentum line, I should change the labels here, but I can't be bothered. So our smooth momentum line here is in white, and what we're looking for is periods where it drops below our lower band here, which is in green, and then closes back above, and that's going to be our buy signals. And then for our sell signals, it's periods where, what is happening here? It's periods where the smooth momentum line is above the upper band and then turns back down, and that's going to be our sell signals. So let's go and copy a lot of this down. And so I'm just going to grab that. And then what else do we need? We're going to need that. Pretty sure that's it. Data's already the index, so that's fine. Oh, these lines that you see, these markers, is because I haven't commented out this, and it's just displaying what's already in that column, which is different, but we're going to amend that now. So what we're looking for then is periods of time where the smooth momentum line is below the lower band and then closes back above it. So that's going to be our buy signal. Let's do that one first. So if data.smoothmon.ilock yesterday, so I-1 is less than data.lower, and yesterday's value of smooth momentum is below the lower band, and today's value, which is I, is greater than the lower band. That is going to be our buy signal, and let me just get rid of that and pop that there in there. And then for our sell signal, that's going to be in reverse, so I'm just going to pop that there, bosh, and then so I've changed that to upper. Okay, and we're going to have to reverse this. So basically, if our smooth momentum line is above our upper line yesterday and below it today, that would be a sell signal. Let me just run everything and just see whether that is making sense. All right, so yeah, much better. Okay, so now we're using this to spot extremes in the smooth momentum line, and you can see it does it pretty well. So you can see that most of the time you're getting buy signals right at the lows, really nice. And so your sell signals can come a little bit early, as we see here, but often are coming in periods where there's a good chance you're going to be able to make a little bit on the downside, or there's a fair chance you could take a quick profit on a short here. So maybe we'll look at a long short for this one. So let us now then throw in a little back test and see if we've got anything to play with. So for this one then, we're going to do a long short, I think. And again, I probably should have had a look at this before, but I would imagine that with these ones, what you're trying to capitalize on is a big drop. So for example, if we have a look at this sell signal here, that's a bad sell signal, right? So it basically doesn't even dip before it starts to go higher. So obviously you're going to want a fairly tight stop. But at the same time, you want to capture a good chunk. So, you know, where you're falling a good sort of 10% lower. So actually, so on the short side, I'm going to put a stop loss here at 1.02 times price. That's 2%. And then I'm going to take profit at, let's do 10% and just see if that works. And I'm just going to comment out the buy for a second. Yeah, there we go. So you're in the market 15, this is just the shorts now. So you're in the market 15% of the time, makes a small profit, which is good. A compounding strategy really benefits from that. Drawdown's pretty horrific. 33 trades and you don't win a lot. But your worst trade only lose you 3.25 and your best trade made you 10%. So not bad. In fact, we're going to keep that. And then for our main buy signal, because our buy signals come so infrequently, again, I don't really want to take a quick profit. So I'd probably be looking to hold this into a sell signal. So I'm probably going to do nothing with that. And let's just run that again. And you can see it makes a very tidy 573%. You're in the market 72% of the time. Drawdown, not that bad, but not great. 60 trades, and that's the most worrying thing, and your win rate's not very good. So with only 60 trades, you can't really say, that this is a statistically reliable sort of trade. So I'll tell you what we will do is we will go back into here, and we will pull this. Yeah, let's grab that. So we're going to add a third or a second buy signal or a third parameter for our logic here. So just to bump up the number of trades. It's a bit of a, but let's do, so elif, and then we'll have that as a 3. So this is basically where our smooth momentum line just turns up. So we're going to add in an extra buy signal. So to add that on the chart then, I'm going to have to duplicate some of this. And I'm going to make that more long entries. And the lambda function needs to change to more long entries. And the column name too, it'll just be overwriting your file. And then we will copy this as well. And we'll make that more long entries, and then we'll make that color blue. So if we go and run everything again, here we go. So, what have I done? Oh. There we go. So, there we go. Lovely. Right. So, have we overlaid more long entries? Let's run it all again. Why is that overlaying? Oh, there we go. I didn't change this. Look for the, so basically it was looking for signal equals 1 in there. Right. So, okay, that's better. Right. So now, you can see that we get more buy signals basically. So we still got our existing ones in white, and we still get the same sell signals, which we would definitely want to keep because they seem to be a lot more accurate. But now we've got more buy signals basically. So if we miss one, then we've got one that we can play in. So what we're going to add into our backtest now is the sell signal equals 3. So that would be, I'm just going to copy this. And then for these ones, I think, bearing in mind they come more often, and we don't really want to interfere with these ones, which are great. Well, I think we'll just use this to take a quick profit. So what I'm going to do is just add a couple of % on top. So our take profit would be equal to 1.02 times price. And then, hey, there we go. So that now returns 745%. You're in the market 80% of the time. Beats the market for the NASDAQ 100. You've got that's a great drawdown statistic. That is just over half of what a passive strategy would have given you in terms of your drawdowns over the last 10 years. 85 trades, so a bit more than we had before. Better win rate because we're winning more often with this one, I guess. Our worst trade is still not very good. but tolerable given the drawdown. And our best trade, obviously, because we're in the market a bit longer, hoping for the big swings, is 26%, which is great. So given that the drawdown is 23%, would we use leverage with this? Well, maybe not, because we don't have any sort of stops on these ones. So I'd be less, if there were stops on all three of those sides, excuse me, I would be more inclined to use it, but there isn't. So, but if we did use it, you would make 5,000% versus 639 over the last, but we won't do it. So, all right, I think that's probably taken ages, so apologies for the length of this video. But if you have any questions about it, feel free to email in info@bubble-analytics.com. This was quite nice. So, yeah. All right. Have a nice day. Take care. Bye-bye.